Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Dan Bird. How you doing, sir?
I'm doing well. How about you?
I'm doing well, man. So last week, woof, rough week in the stock market. We started off pretty good. I think Monday, Tuesday was okay, and then it fell apart. And then we got a strong jobs number as I expected, and that was ugly. Then we got an AMD release, which was ugly. Then we got Tesla breaking. We got Apple breaking. Oh, I think we took out the bottom again. Then we got CPI next week. What the hell is going on?
We're broken.
I
think
video all done. We're broken.
I think last week, by the way, that reminds me of an old customer I used to have. This guy was ran a data center, and I was working for CA at the time. And he's this Hispanic guy. He calls me up one time. This is very early days, CA, like
Computer Associates, for those that don't know.
Computer Associates, very, very early. The guy calls me up and he goes, Dan, my software is broken. I'm like, well, what does that mean? He goes, it's broken. It's broken. So every time I hear broken, I think of him.
Yeah. Yeah. So the stock market is broken. We took out the bottom, the Bally bottom. Bully bottom. How about one of the things that you were talking about that always felt odd to me was you still thought there might be a year-end rally to new highs. Have you given up on that?
No, I haven't given up on it.
Oh man, you are.
I don't know. I don't know if it'll be. I'm not sure it'll be new highs now. But
okay, so you did give up. Okay,
I don't know if we'll make it back to 4,800, but I do think we're going to have an end of year rally.
You think so? End of year rally. Just so I put it in a time frame. Post-election, pre-Christmas.
I would start it the end of October, beginning of November. End of October, beginning of November.
And
like first week in November, I think we're going to start taking off.
Okay, all right. Well, I look forward.
I think once we get all the earnings warnings out of the way, we get the next inflation report, CPI, next week, which we'll talk about that. Yeah. And then we get November 1st is the next Fed meeting, where they'll probably raise another 0.75, 75 basis points.
Yeah, I think so.
And if they do, that will be the end, or it'll be the end of 75 for sure.
Yeah, I think that'll be the last. I think it's going to go 75, 50, 25, pause.
Yeah, I think they might actually pause after 75.
Man, you and you Wall Street guys, you guys keep thinking the Fed's just going to slam on the brakes. Okay,
well, they're going to have other problems if they don't.
No, that's true. I'm starting to hear more and more folks talk about the system showing cracks.
Mm-hmm.
Reverse repo, just being, one of those cracks. And
well, the dollar is too strong. The dollar is just too strong.
Yeah, that's going to cause lots of problems.
We'll talk about that today too. And we'll talk about quantitative tightening a little bit.
Yeah, well, let's look at your newsletter first. There's so much to talk about here. I don't want to be distracted. So let's get into it.
You got to let me share.
Oh, that is on me.
And for those of you out there that see me looking up, I've got one monitor up here, but the camera's on the one at the bottom. So that's why it looks like I'm looking up.
All right, one sec. Oh, now that I'm recording, maybe I don't know. Here we go. There we go. Found the button. Should have it now.
Okay, so newsletter. It's right here. I don't know if you had a chance to read it this week.
I did. I read it. Well, I didn't read it entirely. I read most of it this morning. Yes.
Well, you didn't read the entire thing, which to me means I looked at the cartoons.
No, I read probably 80% of it. Yeah, I didn't read some of the bottom, like maybe the last couple pages.
Okay. I mean, after a while, once you kind of know what the charts look like and how I explain them, you can usually get through it pretty quick. But for those people that are new, that are trying to learn charting, technical analysis,
there's a lot.
Probably spend more time actually looking at it and trying to figure out what I'm saying, what the heck I'm talking about.
Yeah, I was actually surprised by VectorVest and some of these folks, not screaming red, right? This is now showing yellow.
Yeah.
Your bottom finder was really interesting. I'm sure we'll get into that. There's a lot of good stuff in there that had me scratching my head.
Yeah. It's going to be interesting the next couple of weeks. So anyway, if anyone wants to subscribe, it's breakpointtrading@gmail.com. It's free. Just send me an email. I'll add you to the list. I'll send you last week's newsletter. These are some excerpts from last week. And this is Vector Vest here on the right that Mike was just talking about. It's not in the red. It's actually in the middle of the yellow.
Yeah, that surprised me. So,
yeah,
very cool. All right.
And then the one on the right, we'll talk about this one a little bit more. I mean, the one on the left here, we'll talk about that one a little bit more. This is the long term going back to the COVID bottom.
Okay.
All right. So breakpointtrading@gmail.com if you'd like to subscribe. Trying to think of, let's start with looking at some of the charts. Then I'll come back to these three. Actually, let's start with this one because it's real estate related. Okay. You probably have seen this already, but this is just something I ran across. I thought it might be interesting for your audience. Yes. It's the affordability chart, basically. Shows that in 2020, that the peak was almost 759,000, is what 20% down with a $2,500 mortgage payment. What folks could afford, 759,000.
Yep.
On a 30-year mortgage. And now that same criteria gets you 476,000.
Yeah, and this is why the housing market is broken. It's why I've spoken with the editor at Fortune. I've spoken with John Burrs Consulting with the statement that the Fed broke housing. And this affordability chart screams demand destruction. But what most people don't realize, and I keep trying to highlight for folks, we're step 2 of a housing depression, because this not only impacts demand, which is clear as day, almost $300,000, but it's also supply destruction. So if you are in a house and you have a 3% mortgage and now you want to move up or trade or move, you fundamentally can't. There are people that want to, don't even get approved, let alone want to and can. I mean, the housing market's destroyed.
Yeah, well, there are people that may want to, but they're saying to themselves, I've got a 2% mortgage. Why the hell would I want a 7% or 8% mortgage?
Yeah, and again,
6%,
I've actually,
whatever it's at now.
I've done math with older folks like my mom's age. They want to downsize, right?
Yeah.
They have the big home, the kids are gone, and there's one lady that I helped last week, one of my friend's mom, and her payment would go up $1,200. Well, some of that's because she's in California and Prop 13 and those kinds of things. But yeah, the rate's crazy. It's so people are going to be locked in. It's called supply destruction, which not a lot of people have got a hold of. But yeah, housing is broken. It'll be broken for years to come.
The other things that affects, though, is it just ripples throughout the whole economy.
Oh, housing is 14% of GDP. Housing is in a depression, Dan. It is going to pull the economy into a recession. There's no doubt in my mind.
Yeah, no, I agree, because construction workers, materials, all of those things will start to dry up.
Exactly. Yep.
So anyway, that's that. Let's look at some of the charts. Then I want to come back to this when we start talking about quantitative tightening. So this one here is my bottom finder chart that you had mentioned. Let's see if I can. This one's good enough. It's big enough, at least. So this is the S&P. This is the chart down here. You can see the upper trend line is basically following along the 200-day moving average, that dotted gray line right there. So that before we get any kind of meaningful rally into the end of the year, we've got to break through that. And you can see it's declining. It's down to 4,200 now.
Yep.
This is this pink line across here is the Bowley bottom, the June low.
Yep.
You can see the June low right here. We actually closed below it on one day, only one day. But we closed right at it on Friday.
Okay.
And Friday, it closed at the low, almost at the low, which means the only reason it didn't go lower is because the market closed. So there's a good chance this is going to continue going lower next week. The other parts to this is something that I created to try to identify or mark bottom.
Yeah, this is what I spent a lot of time on. Why I actually didn't finish, because I was trying to internalize what this was telling me.
Yeah, so I can help you with some of that. These three here are what's important, not the accumulation distribution. That's just interesting, but The percent of stocks above their 50-day moving average, that gives you the breadth of the market. You know, how many of those stocks in the S&P 500 are above their 50-day moving average, which is a key area that institutions look at to either sell and get out or buy more or make an entry. So if it gets above 50, the 50-day, they make an entry and they buy some. The second piece is the put call ratio, which is down here. Whenever this gets above 0.75, that means there are more people that are bearish than are bullish, meaning there are more puts being bought. More people think the market is going to continue going down, which is what you want for a bottom. You want as many people as possible thinking that it's the end of the world and the market's never going to go up. The more people you have thinking that way, the more likely you're going to get a rally. So it's counterintuitive. A lot of things in the market is counterintuitive. And then the VIX, which is the fear index, the volatility index, whenever that gets over 30, that means there's a lot of fear in the market. So if we look at the June, just compare it to the June bottom, which is right here, you can see this pink line is 10%. So 10% of the stocks were below their 50-day moving average throughout this period. This is about a week, a little more than a week right here. On the put call ratio, it spiked above 0.75. That's this pink line across here. So kind of follow this up to where the low was, to where the 50-day moving average, and then this hit 0.75. And shortly after that, when this started to decline, is when the bottom was put in and we started going up. And then the VIX hit above 30 and through here. And when that started to decline is when the bottom was put in, the market started to rise. So this happened again a week, 2 weeks ago. This was below 10%. This was above 0.75, and the VIX was above 30. All right, then we got a brief rally. We got a short rally, 3 days right there. And you see that the percent above 50 rose above 10%. The put call ratio dropped below 0.75. The VIX dropped below 30, and we got a rally. But then it all started to come back and happen again. Now, one of the reasons why you're seeing yellow on VectorVest and not red is because, yes, we dropped below the June low right here. And this one here was back down close to where it was in June. Actually, it wasn't quite as far, but close to where it was. The VIX was close to June, but not quite as far. And the more importantly, the put call ratio, actually the VIX was down here. The put call ratio started to decline, which means people stopped buying puts and started buying calls.
Interesting.
All right, so they were not as bearish going into here. So that's why you're seeing yellow instead of red, because we are not as overextended as we were in June, even though the price went below the June low. What that is called is a bullish divergence.
Got it.
So if you get lower prices, but all of your other indicators are implying that the selling is slowing down, even though the price goes lower, that is a bullish divergence. And it's most apparent when you look at the RSI, the relative strength index.
Got it.
So you can see here, before, when it hit the June low right here, the RSI, the relative strength hit way down here. When it dropped below and actually closed below the June low, the next point on the relative strength was actually higher.
Interesting.
So the price was going down, but relative strength was going up.
Okay.
So it's the same concept down here as well, although it's kind of inverted, reversed.
Right.
Because the VIX on the put call, you want to be high to identify the bottom, whereas the RSI, you want it to be low to identify the bottom.
Okay.
All right. So that's why you're seeing yellow, not red, because even though the price was lower, the momentum indicators were not.
Okay.
And that doesn't mean they can't get there. That doesn't mean we can't continue. Just like I said, on Monday, I think we're going to continue going down. I think we have a very good chance of hitting 3,500, which, not this one, but this chart here. So this is
3,500 is a number you really haven't thought was possible, if we go back months. Now the market's breaking
down.
down.
I always said that it was there. the 3,500 was the target that we could potentially hit if all of this breaks down.
If it breaks, yeah, you're right. If it breaks down, yeah. Okay.
I said I didn't think that we would, but I said 3,500 is likely and 3,200 is very likely.
Okay.
And the reason is for both of those, and some of the folks on CNBC have talked about this too, although they don't really explain why. 3,500 is a Fibonacci level. If I mark the top from December, way up here, and I mark the bottom of the COVID crash way down here, and I use those as my anchors for Fibonacci. And in my newsletter, by the way, I put a link to Fibonacci if you want to learn what that means. Just click on the link and it will explain what the Fibonacci numbers are. These are all found in Nature. Fibonacci was a 15th, 16th century mathematician that started to notice things, a particular number sequence where you take two numbers and you add them to each other. So 1 and 1 is 2. And then you take 2, you take 3. So 2 and 3 is 5, right? 5 and 7, 5 and 2 is 7. So you take the 3 and you add 7. You just keep adding those up. Those are Fibonacci numbers. For the market, it is 38.2% is a key level. 61.8% is a key level. And then 100% is the anchor. So 0 and 100 are the anchors. And 38 and 62 roughly are the key levels to watch. So 50 is not officially a Fibonacci number. So, but because it's 50%, it's one that most traders watch. And if you follow this 50% level back over here, back after we started recovering from the COVID crash, we had this period through here for about 3.5 months where the market just went sideways or started to go back down, and people thought we were going back down to the low again, right in through here. Well, it kept hitting that 50% level. Interestingly, 50% level didn't even exist back then because we didn't have a high to anchor at all. But just coincidentally, once I drew it from the high to the low, that 50% level now is a really important level. So that's 3,500. You see right here is 3,510. So that's why I said 3,500. And 3,200 is the next Fibonacci, which is a key Fibonacci level. 3,200 is a very important Fibonacci level. So and I think we probably are going to go to 35, maybe pretty quickly. If we drop through that, then we most likely are going to go to 32. But there are some things at play right here that imply that we are extremely oversold and we may get another nice bounce. All right, so anyway, that's a long term. That gives you the 3,500 and the 3,200 and the reasoning behind those. This is the one where I had the head and shoulders before. I've now removed the inverse head and shoulders. Because that is no longer in play. We're looking for a right hand shoulder over here. It didn't happen. So there is no more inverse head and shoulder. So now we're just watching the levels to see where it goes. And this one here is more of a daily chart that ties in the VIX and the 10-year Treasury. You see where how the 10-year Treasury has gone up, and the 10-year Treasury is directly inverted, correlated to the market. As the Treasury rises, the market goes down. We'll talk about that some more. Right now, we can talk about it with quantitative tightening. One last thing. This is my rotation chart that we've talked about many times before. Remember back in December when the market was hitting new highs? All of the institutions were rotating out of growth and out of technology and rotating into value and defensive sectors, even as the market was hitting new highs. They continued to rotate out all the way through till June. And this is the reason that Bowley called the June bottom, is because when we hit this low on the price, again, it's a bullish divergence. We hit the low on the price, but the rotation into defensive and value stopped. It actually started to go up, even though we're hitting lows. So that's the reason he called that bottom. So I was curious, does that mean since we've now broken below the bottom, theoretically, that rotation should actually be below the June lows, right?
It's only there in one occasion.
It's only there for technology.
Which could mean 3,200's around the corner because these other things could fall.
They could fall, but they're still holding up, which
Yeah,
to me,
they
what
are.
that means is institutions are not rotating back to defensive.
Okay, but just technology. Technology's out of favor.
Just technology, right?
Okay.
Which is the two main ones in technology is semiconductors and software. And
Yeah, AMD
semiconductor
got
fell apart
smashed.
last week,
Yeah.
right?
Yeah.
AMD brought all the rest of them down.
Yeah, rightly so.
So yes, if we get to 3,200, I would expect that these would go below here. But frankly, I think they might get back to here, but I don't think they're going to drop below.
Okay.
I think institutions are still positioning themselves for a rally.
Yeah,
they might still think that it's going to be 3,200, but they are not selling their.
No, I think there's a lot of Wall Street folks, you yourself, my Monday guest Taylor, all think the Fed, Oliver, you all are hoping the Fed pivot's coming. I think you said it earlier, right? We're going to get a 75 and then pause. That's a Fed pivot.
Right.
Others think we're going to get 50 instead of 75. That's a Fed pivot. Some people are still calling for a Fed to cut. I mean, folks, higher, longer, faster. It's
all right. So let's talk about that. Let's talk about quantitative tightening and whether the Fed is going to cut. Interestingly, in preparing for this session, I found a really good article. I wish I had found it before my newsletter, but I'll put these things in next week. It talks about quantitative tightening, and it gave some real interesting charts. So this is the pace of the Fed rate hikes compared to other periods.
Yep.
And this was on September 13th, which I think was before the last rate hike. I think right now we're at close to 3%, aren't we?
Yeah, we are. Yep. We're at 3 to 3 1/4. So it's up.
Right.
Yes.
So this blue line should actually be up here closer to the 1994 and 83 lines. And it's a straight line up. It's not a pause and up and pause and up. It's a straight line up. All right. So let's see. I'm going to actually draw that in. So this would be a line something like
correct.
that.
Yeah, that's where we are today. Yes, correct. Roughly.
Yeah, so it's more like that, maybe even a little higher, like 3 1/4. So right now that line looks like that for this cycle. So you can see it's equal to 94 and 83, but it's straight up. It's not, up and pause, up and pause.
Yep, it's straight up.
Straight.
No pause. We had a quarter, and then we've had now, I think, 4 successive 75s.
Yeah, and this is the reason, even if they do 75 the next time, and it'll be interesting to see what we get in a CPI number. But we might get a lower than expected number this time.
I'm sorry, what? So which number are we talking about lower than expected?
The CPI.
Well, let's talk about that, because that's been so again, I want to highlight, like we did last time, are we talking lower headline or lower core?
Well, the one on, by the way, in my newsletter, I put these before and after shots of Dion coming through. This is Fort Myers Beach. This is decimated. This is the Lanny Kai Resort, Fort Myers Beach. But this is last week's calendar. Here's this one coming up. So CPI expectation is 8.1.
Okay. So that's headline, just so we're clear. That's headline.
This is headline, yeah. So I think this might come in lower than that.
Okay. You want to throw something out there? Are we talking something with a 7 handle?
Maybe a 7.9, maybe an 8, but it won't be a lot lower.
Okay.
But I think it might be a little bit lower.
Okay.
And the reason I say that, we'll look at this after, next time it updates, which I think this updates monthly. So up here you can see the headline and the core numbers, and then PCE, which is the one that the Fed watches.
Yeah.
So, core went up, headline went up a little bit, PCE went up.
Yeah.
But down below is the commodity, the CRB index. And you can see what it's made up of: energy, agriculture, etc. Mostly energy and agriculture.
Sure.
So the next number that we get, which will be, so this one is not updated with the September numbers. Actually, the next one we get will be for September, but this is not, this will be updated after the next one. But it will be updated for this period through here, which actually it looks like it's higher. So it actually might come in higher.
Yeah. I don't,
Commodities.
again, I think headline's going to, again, headline is not the one that's important. Just like last month, headline's going to be kind of goose because we're releasing 1 million barrels a day from the oil reserve. You want to see headline inflation spike, wait for next month. Headline's going to go up next month. But core, it's all about core. I went like yesterday, it might have been the day before, Dan, I went and looked for expectations for core. Just for people realize, last month CPI reading for core was 6.3. This is year on year, 6.3, not month on month. They're expecting 6.5 for core.
Yeah, this is the number down here. This is 12-month.
Yeah, it's
period,
not good.
6.3.
It's not good. They're expecting 6.5, Dan. And even if they get what's expected, you're going to get hammered with 75. 75's coming. Strong jobs. Core inflation's going up. We're going to get 75, 50, 25. I don't see any way around it.
Yeah, I agree with you on the 75.
Yeah. Okay.
I think we will probably get 75, but where was I? But 75 would put us
4. Takes you to 4.
way up here. 4. You can go all the way back to 2004 to find a reading higher than that.
Which is really interesting because I don't know if you know this. There was an argument, I think George Gammon made this, that every cycle had a lower high of the Fed funds rate. Well, we just blew past 2015, right? Now we're going to go past, basically you can't take the Fed rate above.
We blew past 94. We're at the 83 level right now.
Yeah, and we're going to go higher. We're going to take out 04. The Fed is not playing higher, faster, longer.
Yeah, so the reason I think
the market doesn't believe it. Stock market people don't believe it. I don't get it.
I think they believe the 75.
Well, they believe the 75. Now they do. Yeah.
Yeah, now they do. And that's why we're probably going to hit 3,500. Especially if we get a higher CPI, we could hit 3,200 very quickly.
Oh, it could be ugly. Yeah. CPI on Thursday.
But the issue here is, and this chart, I think this is the thing that jumped out to me when I looked at this. The Fed is raising incrementally without pausing, without stopping.
Yeah, there's no stairs.
So they haven't determined what the effect of their rate hikes are yet.
Yeah, and that's why I think
it doesn't even happen in a quarter. It takes longer than that.
No, it's somewhere between 6 and 18 months, the delay. Right. You're correct.
So it is getting to the point where they will lose credibility again. They think they're gaining credibility by doing this, but if they continue to do this, they will continue to lose credibility.
See, I don't, again, this is a lovely conversation because again, I think I think they're racing to get to 4.5 and then they pause. That's what I think is happening.
But that is a mistake. That is a policy mistake. Racing to 4.5 is a policy mistake. I don't disagree that they want to get to 4.5, but racing to get there is a mistake.
Okay.
It is. I mean, let me show you what I think I'm not sure if I included the dollar chart on here. Let me bring
that's fine.
Let me bring the dollar up. Here's the US dollar. I mean, it's going parabolic.
Yeah, and it's going to, I mean, again, if they race to 4.5, which would be sometime in January or February, I don't know what the first meeting is, that'll take us to 4.5. This will get stronger. I'm not passing judgment on good or bad. I'm just saying I think it's going to happen, and we're going to have to deal with an aftermath, and there's going to be a lot of pain in a lot of places.
And that's why I think the Fed will be making a policy mistake and will lose credibility if they continue on this path.
Yes, again, they stayed too low for too long. They're going to go too high too fast. All kinds of stuff is going to break. And then we're going to spend 2023 just getting out of quagmire. I don't have a great feeling.
So do you think we have a Lehman moment coming?
Well, again, anything is possible, right? Nobody saw long-term capital coming. Nobody saw Lehman coming. We could see emerging markets just terrorized by a stronger dollar. The UN, I mean, I don't see this. This will end badly. Here's the deal. I believe the Fed, we could, absolutely. There could be several. There could be several. Here's the deal. I think the Fed wants to go to 4.5. The only thing that stops them is a disaster somewhere. I'm not talking little disasters. I'm talking a total epic disaster. And where I'm sitting today, I just hope we don't have one of those.
Right. You can see the relationship between gold and the dollar.
Yeah.
By the way, for those traders out there, when the dollar does break,
yeah, gold will go up.
Buying gold would be a good place to be.
But if you got 3 more months of higher rates, gold's not going anywhere.
That's right. It's going down.
Yeah. Yeah.
It's going lower.
Yep.
And then this is the 10-year treasury down here, along with the S&P. You can see that they're inversely related.
Yeah. It's, again, I don't feel good calling this, and I hope I'm wrong. My current best total guess is they get to 4.5 and stop all year. And the only way they cut is they break something.
I think if they get to 4.5 by January, February, then it's too late. They will already have caused a crisis.
Yeah, is it lots of little crises, or is it a long-term capital, pull all the banks together on a Saturday and bail out the system crisis?
Long-term capital, Lehman Brothers, 1929 crash, 87 flash crash, which was long-term capital.
Yeah, it was.
I mean, those are the kinds of things that happen in October.
Yeah, it can. Yeah.
October is called a bear killer, but it's also the black swan month.
It is.
This one here I thought was interesting too. Past cycles, the Fed has lowered rates soon after hitting the peak. So they hit a peak. These gray areas are the amount of time they stayed at a peak before starting to lower.
Yeah. I think 2006 was 11 months.
Yeah. 2006 should be down here, was 14.8 months.
14 months. Okay, good.
Yeah. And we're right now at, they started raising in February.
Yeah, February, 25 basis. Yep.
Right. So we're at about 7 months right now.
Yeah, we've never raised rates this fast before. And we have
never raised them this fast, but the average is 9.5 months. So I mean, they could keep raising for 2.5 more months and still be within the average. But not this fast. You can see the trajectory here compared to the other ones in the past. Yeah. So this one's actually a little higher than this.
Yeah, because we don't have the last 75 in that.
Right. And then this one here, talking about quantitative tightening, this shows you the times when they did QE and the times they did QT. Quantitative tightening, the market. This is the 10-year treasury. So the treasury initially goes up. I highlighted that here. Previous QT, 2017 and 19, 10-year treasury yields initially rose, but then declined because the economy slowed and inflation pressures eased. So while the 10-year is going up right now, just like in this period, once that started to take hold, it started to come down pretty rapidly.
Yeah, well, QT, as I've said on many of my shows for months now, freaks me out because we've only done it a couple of times. It didn't end well. We're doing it bigger now. September was the first month of 95 billion or 100 billion reduction. It's gonna hurt. I just know it's gonna hurt. I just hope it's little hurt, not big hurt.
So QT, so I'm sure you've explained this to everybody. The QT is where the Fed stops buying bonds and they just let the maturities run out.
Yeah, they roll off. Yeah.
Which reduces liquidity in the system.
Yep.
Or they actually start selling bonds, and they're doing both right now.
Yeah. Yeah.
They start selling bonds, which also reduces liquidity in the system.
Now when they really ramp that up, right? Right now they're just letting maturities roll off, which is relatively slow, and they're not. But when they really start selling, that's going to be a problem. Because as I understand it today, they're actually not selling mortgage bonds. They decided not to sell because rates are already so high. But if they ever decided to sell, that will take rates higher. So, yeah, it's interesting.
Yeah.
So,
yeah, up here it said Fed officials in the past indicated a preference for holding only treasuries at a level close to 20% of GDP, compared to the recent peak of 35% of GDP. That could take some time and involve a reduction of approximately $3 to $4 trillion, which would likely be spread out over several years.
Yeah, they're doing
Although
100
that's-
billion a month, so that's, that's 1.2 trillion a year if they can do that rate. And
yeah,
I have
so
I have no faith they can.
right. Although that sounds scary, may not have a dramatic impact on the bond market. But that's assuming that the economy slows and inflation pressures ease. The economy hasn't really shown much signs of slowing.
Yeah.
We'll see what the inflation number is next week.
Yeah. I don't know how that help. Do me a favor, show your newsletter one more time, and then we will get into episode number 2, where I list 10 stocks that I'm have on my shopping list.
All right. And we'll just look at the charts and see what they look like.
Yep.
All right. So if anyone would like to join, I will send you last week's newsletter. Those 3 charts that I just showed you are not in it, but they will be in next week's. And along with the article that I pull those from. But send an email to breakpointtrading@gmail.com. That's breakpointtrading@gmail.com. And I'll send you the newsletter and add you to the list. And if you ever want to be taken off for whatever reason, just send me a note and I'll take you off right away. No big deal.
Thank you very much. Talk soon.
All right. Thanks.